Let's explore this financial analysis problem that deals with the consolidated financial statements. We've got the Outback Oil Company, I'm reading right here, the parent, and they acquired 100% of the common stock of Hot Top Development, the subsidiary, for $125,000 on January 2nd, 2000 X1. Their financial statements follow, and if you click here, you get what appears in this data table. So we're getting the balance sheet and the income statement of Outback Oil, as well as, that's the parent, as well as the subsidiary, Hot Top Development. So the first question they ask is, what would be Outback Oil's net income for 20X1 if it had not purchased the Hot Top Development stock? All right, now we're assuming there's no intercompany sales, no profits captured in intercompany sales. So we're taking a basic assumption here. And what you would do is you'd look at the net income of Outback Oil. It has $1,950,000, but it included the income of the subsidiary of $450,000. So to come up with what the income would be if they didn't purchase Hot Top Development, they wouldn't have the $450,000 included in the 1950. So if we subtract $450,000 from $1,950,000, we get $1,005,000, and that's the answer to requirement 1. Okay, next we'll take a look at requirement 2, and it reads, after acquiring the Hot Top Development stock, Outback Oil prepared its income statement by showing its claim to Hot Top's income as part of other income. Prepare a consolidated income statement for 2000 X1 and a consolidated balance sheet as of December 31st of 2000 X1. Use the balance sheet equation format for the latter. Okay, so let's first take a look at the consolidated income statement. What we would do is use the information and just drop it in, right? Revenues less expenses gives us the operating profit. We do the same thing for Hot Topic, right? So it's really just an exercise in copying once you conceptually understand that we're adding the sub to the parent. Okay, so we add the two revenues to come up with consolidated revenues of $7,300,000 right there. And then we add the expenses of $4,550,000 from Outback to the $800,000 Hot Top, and we come up with consolidation of 5,350. So that gives us consolidated operating income of $1,950,000. Now, Hot Topic had $450,000, right? That number right there. And since they're 100% owned, we would show that $450,000 is its 100% pro rata share of subsidiary net income, and that gets us to the $1,950,000 that we see there. Okay, next they ask us to prepare the consolidated balance sheet, and they say use the balance sheet equation format. And you can see the results here. We've got the investment in Hot Topic listed as one column, cash and other assets listed as another, and we've got Outback Oils on top and Hot Top's accounts on bottom. I'm having a tongue twister saying that. So what you know is they invested $125,000, so they've got an investment in Hot Topic. But when we prepare consolidated financial statements, the investment goes away. Instead, we simply add all of the assets of the two companies combined. So that's why we're going to eliminate the $125,000. And then we'll also eliminate what the $450,000 of income of Hot Topics, because that amount is included in the income of the consolidated entity. Okay, so when we put that together, we get the balance sheet that you see here. Okay, next we take a look at requirement 3, where they say, suppose Outback Oil Company bought only 60% of the subsidiary for $75,000. Okay, and now the revenue and other income is $6,320, not $6,500, and that's in millions, right? So that's $6,320,000 instead of $6.5 million. And they ask us to prepare a consolidated income statement. Well, what you've got to do here is you recognize Hot Topic still made $450,000, but we're only going to claim 60% of that. So 60% of the $450,000 would show up here. Okay? And so that's why requirement 3 would look slightly different. Okay, and then on the last part of this problem, they've asked you to prepare a consolidated balance sheet under this second scenario where they've only purchased 60%. All right, now, the few differences we'll see here is there is a $75,000 acquisition price instead of the older price. There's also a non-controlling interest. What that represents is that portion of the company's assets that really aren't controlled by the consolidated entity. Okay? So if we only own 60% of it, somebody else owns 40%. So we've got to calculate what that value is. And so here we go through the eliminations again. And when we're done, we get the numbers that you see on this page.